Tonight we're going to talk about investment. And investment is a difficult business. As we've seen over the past 5 or 6 years, it can be pretty tough going at times. It requires diligence and it requires discipline to be successful. Get it wrong, you can get badly hurt. Get it right, you can make some substantial returns. But over the past 30 years, what we've seen and what we've learned is that there are some constants in the investment markets and things that if you take account that you can control your destiny. The first of the constants is that investments always go in cycles and the cycles always repeat. And we're right now in a low interest rate cycle. So that if you had panic when the markets were falling, the share markets were falling, and put your money into fixed interest and you're still there, you're in trouble. So it's your decision making about achieving outcomes that is what investment markets are all about. So what we're going to share with you today are our 10 top don'ts and 10 top do's. And if you follow these rules, you should be able to protect yourself and achieve success. What I'm going to do is start with the don'ts. Bad news first, good news last. The mandatory disclaimer that this is general advice and you shouldn't take any action without first seeking professional advice. So let's start with the don'ts. The first don't be investment driven. Successful investment's about outcomes. It's not about investing in investments that are fads or top tips or all of this stuff, because ultimately you'll come unstuck. And the financial industry is very good at fad investment. And they'll follow the cycles, and when things go down, they'll find a way of creating an investment. Like right at the moment, the fad is income-driven investment. So you can buy a managed fund that is going to develop income. But by the time you strip them back, you're probably better off just investing directly yourself rather than paying somebody else's fees. Don't speculate. You know, the latest hot tip is very dangerous. And I can remember many years ago, and we've made all the mistakes. And I can remember a broker ringing me, a very good friend of mine, broker rang me and he said, "John, it doesn't get better than this." Sadly. I don't want to think about it.
You went in the hunting club where you
Similar. Don't set and forget. You often hear the word set and forget about investment. Yes, buy good investments you're going to buy for a long time, but don't set and forget. Investment you have to work at. You have to keep on revisiting, looking at things and taking the appropriate actions when they're justified. Don't invest in tax-effective schemes. History is strewn with failed tax-effective schemes. Ostriches, West Australian wildflowers, agribusiness, viticulture schemes. You must never invest in something that relies on a tax break to make money. You need to look at the investment and make sure that it's in standalone on its own two feet and make money without the tax break. I'll tell you very quickly a story. I was invited to go on a discovery tour up to Rutherglen to a viticulture investment, a couple of very well-known winemakers. And we all hopped in a bus and off we went. And we arrived at this place and they were just planting rootstock. And the whole basis of this scheme was that the investors put the money in to develop the vineyard. They bought the rootstock and they paid for it to all be cultivated. And they got this tax break along the way. And after 7 years, they mandatorily handed it back to the developers. Now I know that I can see that there's a number of people here who are quite experienced in the in the wine consumption area. Can anybody tell me how long it takes for a wine grape to reach maturity? 7 years. So here you are, investing in this thing for 7 years, getting your tax break, and then they take the investment and take all the profits out of it. Absolute rubbish. Ignore, please cancel your newspaper subscriptions. Journalists are in the business of selling newspapers, not telling you the truth. And I think probably, it always happens, but I think probably over this past period through the GFC, it's got to be the most sensationalist, uninformed reporting that we've ever seen. Just absolute rubbish. All the stories about the end of the world coming because Greece has got a debt. Greece is less than the size of Tasmania in terms of its economy. It was never going to be a problem. And yet it's been blown up out of all proportion. People make decisions out of that sort of reporting. You need to get your information from reliable sources. Markets are driven by fear and greed. When the markets are down, people are fearful and they sell. When markets are up, everyone gets buoyant and enthusiastic. This is the taxi driver's latest stock tips and goes out and buy when the market's up. Totally the wrong thing to do. When markets fall, you buy good assets at a low price. When markets are up, you take profits. If you do that and you do it religiously, then you really can't go wrong. And so one of the hardest things we have to do is convince our clients, many of who are here, to sell their best before we investment when it's at its top. But that's the way it is. So don't be afraid to take profit. And this is all about rebalancing your portfolio. And I'll talk more about that in a little while. Don't make long-term decisions on short-term influences. It's a very easy thing to do, particularly when the markets are volatile, you get fearful, you forget about your long-term targets, and you start to make long-term decisions based on short-term influences. And you can easily come unstuck. You really need to, this is where the discipline comes in. You need to keep your eye on the target and keep disciplined about the decisions you're making. As you know, we're generally speaking, we're direct investors. The problem with pooled investments, managed funds and that sort of thing, is that you lose control. For example, if you own a BHP share, you know what it is. It's a BHP share, and you know what the company is. You can look and see how it's going to perform. If there's a market downturn and people start selling their BHP shares, it has no influence on you at all. However, if you're in a managed fund and people panic when the market's down and start selling units, the manager has to sell units to satisfy the demand. The only assets they can sell are the quality assets they hold, and eventually it depletes the portfolio. Control is everything. We do use some managed investments, as you know, in certain market sectors, but that's only because it's the most effective way of doing it. But generally speaking, you need to keep control. Don't invest in things you don't understand. And that includes anything we bring to you, and you don't understand it, put your hand up and say, John, I don't understand this. And we'll make sure that you're fully, we'll never bring anything that's so complicated and exotic that you won't understand it. But what we saw, for example, before in 2006, 2007, the flavour of the month was pooled global corporate bond schemes. And people come into our boardroom and show us these things, and we'd all said, well, we're not that dumb, but we do know a bit about these things. And they explained this stuff to us, and we got no idea. We all looked at each other and said, what on earth are they talking about? So we can't understand it, you know. And of course, this was the forerunner of the GFC, and these are the sorts of structures that fell over. So we'll move on to the do's, move on to the good news. First step in any investment activity is have a strategy. You need to have the what, why, when and how. You need to understand what it is you want to achieve, why you want to achieve it, when you want to achieve it, and how you're going to do it. So for example, through a typical life cycle of investment, you might start wanting to buy a house, educate your kids, go on holidays, plan for your retirement, live comfortably in retirement and eventually estate planning. So all of these things are going to require a long-term strategy plan and a long-term investment strategy that fits into that strategy plan or any structure that goes with your strategy plan. So you need to get good guidance on the sorts of structures that you need to put in place and the sort of investments that go with them. Only ever buy quality assets. I mean, we've proven through the years that if you invest at the quality end of the market and you have the disciplines to sell high and buy low, you can get very, very attractive returns. And it's further bolstered by cash flow, which is just another aspect of a quality asset's going to generate income. So there's no need for you to be looking outside the quality end of the market in any market, whether it be property, equity, or fixed interest. That you always get reliable and good returns. Rebalance is absolutely essential in good strategy management. So that when you, let's take for example, bottom of the GFC, our banks have dropped 40%. So we're in there buying like crazy, now back beyond what they were. Those clients have made a lot of money on those banks over that short period of time. We're not going to sell them, but we are going to take profit, because what will happen is that your share market exposure is out of kilter with your strategy. So you need now to be selling your share market exposure down and buying into where will we be buying? Bottom of the interest rate cycle, that's where we're going to go. Because you want to know that when the interest cycle recovers, that you can recover with it. That's the theory. And if you practice that diligently, you just cannot go wrong if you're buying quality assets. I said don't invest in tax-effective schemes, but do take tax and inflation into account, two vital elements of any investment. This is where the structuring comes involved, that you need to get good accounting advice on what sort of structures that you'll use to minimise your tax obligations through various legal mechanisms, and also in the selection of your investment, where some investments can provide tax offsets and so on. But again, we're not talking about exotic tax-effective things, we're talking about legitimate, ordinary investments that you understand, that can be structured properly to give you the best tax and tax outcomes. Inflation is all about having growth in your portfolio, that you need to have reliable growth at least ahead of the rate of inflation, just to keep pace. If you invested your money in a fixed term deposit for 10 years, and inflation was running at 3%, you would lose something of the order of 25% of your value over that period, 10-year period, just by the erosion of inflation. Good investment needs good research. You need to know what you're doing. You need to look and investigate, make sure that you can cover off as many of the points as you possibly can. Research isn't buying the newspaper, not even the Financial Review or specialist media. By the time these things come out, it's already happened. It's too late. You need to get good research. We spend a lot of money on research, and I'll just very quickly tell you that our major research provider is Morningstar, which is an independent investment house. But we also supplement that with another research provider called FN Arena, which is a consensus research of around 12 of the major research houses in Australia. So that gives us a consensus view about what everybody else is thinking, and we match it against Morningstar. And that's how we make our decisions. So we're getting the best information from the best sources we possibly can. So when we choose an investment to put in your portfolio, then you can bet that it's been through our filters, and we've done all this research before we recommend it to you. You need to make rational decisions, think things through, not get carried away with the noise, not get carried away with emotion. Think rationally about what it is you want to achieve. Concentrate on the rationale, concentrate on the strategy, not on the investment. The investment's just a tool. So the selection of investments really, or the characteristics of the investment of what it can do for you, rather than what it is. Buy low and sell high. I know it sounds glib and probably obvious, but it's a very hard thing to do. And everybody gets emotional. Even the most seasoned investors get emotional. But it's about the discipline that I talked about before. That you need to make decisions that sometimes might be against your better judgment. But if you think this theory of buying low and selling high, if you adopt a disciplined, rebalance discipline, then you're going to it'll force this to happen. Because as one sector outperforms the other, you're going to be forced to take profits. Risk is important in assessing investment, but there's a difference between investment risk and market risk. Market risk is what we've just recently experienced, where the overall market has gone down. That doesn't necessarily say that the investments in the market are any worse than they were before. It simply means that the overall market sentimentally has gone down, driven by something, a lot of emotion or a cyclical event. So when the market goes down, it's not a time to panic and say, well, my investments are no good. It's a time to analyse your investments and start to say, where are the opportunities? So it's all about reaction, or how you react to market trends, and the difference between if it's in the individual investment goes down against the market trend, that's a problem. And that's where you need to react very quickly. As I said before, do control your investment outcomes, and one of the most important control factors that we employ is cash flow management. To make sure that your portfolio is underpinned by cash flow, so it's not just all about what's going to be the next best performed investment. It's a matter of controlling the outcomes, including things like cash flow. And by having those sorts of disciplines, it'll make you concentrate on the important issues rather than being carried away with just the peripheral issues. And finally, you need to get good advice. And I think that goes with anything that's as complex as investment is. It's not just the investment, it's all the other things that go with it, all the legislative events and structure and strategy. Our advice team has between it over 75 years experience, 5 bachelor degrees, 3 master's degrees, 6 graduate diplomas, 13 professional designations, and does more than 200 hours of CPD a year. And it's still hard work. So it's not a place for the uninitiated or the unskilled. So please make sure, whether it's accounting advice or it's financial planning advice, make sure that you get good advice. So that's our final do. So those are our set of rules for successful investment, and the things that if you follow those rules and you're disciplined about it, then really you should be able to get good outcomes. But in the meantime, we'll do it for you. So look, thanks for your attention, and I'm happy to take any questions that you might have.
Hi, thank you. How do you decide when a share or an investment is high enough to sell, or when it's at the point low enough to buy?
In our research,